Welcome to Tesla Daily News podcast on December 18th, 2025. Today, we're digging into two big forces moving the Tesla story right now, a major Robotaxi milestone that's exciting the market, and a serious regulatory and legal risk in California that could hit sales and the brand. Let's start with the headline that helped push Tesla shares to fresh highs. Story 1. Tesla says its Austin Robotaxi pilot is now running without safety drivers. Here's the hook. Tesla is claiming a step change in autonomy, cars operating in Texas with no human safety driver behind the wheel. Context: autonomy is the single biggest valuation swing factor in the Tesla bull case. If investors believe Robotaxi revenue is real and near-term, you can justify much higher multiples than a traditional automaker. If autonomy is delayed, margins and growth have to come primarily from vehicles and energy, and the valuation math changes fast. Details. Reporting out of Germany's Frankfurter Allgemeine Zeitung says that about 6 months after Tesla started its limited Robotaxi pilot in Austin, the company has removed human safety drivers from the vehicles. That matters because most real-world autonomous programs start with a safety driver, then move to remote supervision and progressively lower human involvement. Tesla running fully autonomous in a constrained service area, if accurate, signals confidence in the current full self-driving stack and operational readiness. Impact. This kind of milestone can move Tesla because it shortens the perceived timeline to a real Robotaxi product. We also saw that reflected in the market narrative. Multiple outlets reported Tesla closing at approximately $489.88, an all-time high close, with market cap around $1.63 trillion. Takeaway for investors, the key question isn't the headline, it's the scope. How big is the geofenced area? What is the weather and traffic complexity? What's the disengagement rate? And what level of remote monitoring is involved? Those operational details determine whether this is a scalable business or a limited demonstration. Story 2. Morgan Stanley projects a massive Robotaxi fleet, up to 1 million vehicles, by 2035. Hook. Wall Street is putting huge numbers on Tesla Robotaxis again, and that narrative is feeding directly into the stock. Context: big, long-dated Robotaxi projections are essentially a bet on Tesla becoming a high-margin network business, more like a platform than an automaker. Details: a report citing Morgan Stanley says the firm expects Tesla's Robotaxi fleet could expand dramatically, with a path to roughly 1 million Robotaxis on the road by 2035. The same reporting references potential early Robotaxi rollout assumptions beginning in the second half of 2026 and continued attention on Tesla's dedicated Robotaxi product, often referred to as Cybercab. Impact. These forecasts matter because they can push price targets, change institutional positioning, and encourage multiple expansion, especially when the stock is already momentum-driven. But remember, a 2035 fleet forecast is extremely sensitive to regulation, safety performance, insurance liability, consumer adoption, and hardware cost per mile. Takeaway: treat long-range Robotaxi fleet numbers as scenario analysis, not a baseline. The near-term stock driver is whether Tesla can turn autonomy progress into measurable commercial deployment with transparent safety metrics. Now let's pivot to the biggest downside risk in today's news cycle, California. Story 3. California threatens a 30-day sales suspension over Autopilot and full self-driving marketing. Hook. Tesla may face a 1-month halt on selling and even manufacturing vehicles in its most important U.S. state unless it changes how it markets driver assistance. Context: California is not just a large market, it's also a regulatory bellwether. A negative action there can influence other states, impact consumer trust, and create headline risk that bleeds into national demand. Details: multiple outlets, including CNBC, TechCrunch, Forbes, and Business Insider, report that a California administrative law judge found Tesla used deceptive marketing language around Autopilot and full self-driving. The California DMV is giving Tesla a compliance window, reported as 60 days in one account and 90 days in another, to modify its advertising practices. If Tesla fails to comply, the penalty could be a 30-day suspension affecting its ability to sell new vehicles in California, and some reporting also references manufacturing restrictions. Impact. This is material. Even if the suspension never takes effect, the process itself can force Tesla to rebrand features, adjust website language, retrain sales staff, and potentially slow FSD take rate if consumers perceive the system as less capable. It could also create legal spillover. Plaintiffs' attorneys and insurers pay attention when regulators call marketing deceptive. Takeaway: watch for Tesla's exact changes, whether full self-driving becomes more explicitly labeled supervised everywhere, whether autopilot language is tightened, and how quickly Tesla executes. For Tesla, this is a classic case where compliance speed matters as much as the underlying ruling. Story 4. The autonomy contradiction, FSD, must be supervised, but the branding implies otherwise. Hook. Tesla's branding is colliding with the reality that the system still requires a human driver's constant attention. Context. Tesla has long argued its naming is aspirational and that users are warned to supervise. Regulators argue the overall impression can still mislead consumers. Details. The judge's view, as reported, is that marketing created a false impression that Tesla vehicles could drive themselves. That is exactly the line regulators focus on, not what the fine print says, but what an average buyer believes after seeing the product name and promotional claims. Impact. If Tesla is forced into more conservative naming, that can reduce consumer excitement and FSD attachment rate in the short term, but it may also reduce regulatory pressure and improve trust over time. Investors should consider both a near-term demand and software revenue headwind, and a potential long-term risk reduction if it leads to clearer expectations and fewer high-profile incidents. Takeaway. If Tesla can't sell near autonomy credibly, the autonomy valuation premium can wobble. The market is currently pricing optimism, so any reputational or regulatory setback around FSD can hit harder than similar news would for a pure auto company. Story 5. Competition check. Waymo's funding talks signal the Robotaxi race is intensifying. Hook. While Tesla is grabbing headlines in Austin, Waymo is reportedly preparing a huge capital raise that could accelerate its scale. Context. Investors sometimes treat Robotaxi as a winner-take-most market. In reality, it may become city by city, regulator by regulator, with multiple winners and different cost structures. Details. CNBC reports Alphabet-owned Waymo is in talks to raise about $15 billion, with valuation discussions as high as roughly $110 billion. Other coverage references investor conversations and large funding ambitions. Impact. For Tesla, this matters because Waymo is the most credible U.S. incumbent in commercial robotaxi operations, with real rider volumes in select markets. More funding means more vehicles, more compute, more mapping and operations investment, and potentially faster geographic expansion. Takeaway. Tesla's advantage is manufacturing scale and vertically integrated software deployment. Waymo's advantage is longer time in driverless operations and a more regulator-friendly posture. For Tesla investors, the right question is, can Tesla reach driverless scale with lower cost per mile than Waymo while navigating stricter scrutiny? Story 6. Europe's policy shift on internal combustion bans could change the long-term EV adoption curve. Hook. The European Union is reportedly stepping back from a hard ban on new gasoline and diesel car sales starting in 2035. Context. EV mandates shape automaker investment and consumer adoption. If policy becomes more flexible, competition could shift toward hybrids and efficient combustion vehicles for longer, potentially slowing pure EV penetration. Details. Reporting in European outlets indicates the EU is pulling back from the outright 2035 ban while still pushing for major emissions reductions. Numbers cited include a 90% reduction requirement for new vehicle exhaust emissions. Impact. For Tesla, this is mixed. On one hand, a slower mandate-driven transition could mean slower market-wide EV adoption in parts of Europe. On the other hand, if legacy automakers reduce EV urgency, Tesla could keep a stronger technology and cost lead, assuming Tesla can maintain pricing power and protect margins. Takeaway. Watch Europe for incentives, fleet rules, and emissions targets, not just the headline of a ban. Tesla's European demand and margin profile can be very sensitive to policy, especially in price-competitive segments. Before we wrap, one more quick market note tied to sentiment. Tesla's rally has been happening alongside broader market crosscurrents, mixed equity performance, and investor focus on macro data. That matters because when Tesla is trading on autonomy narrative, risk-on versus risk-off can amplify moves. Let's close with the big themes. Today's Tesla story is a tug-of-war. Optimism on Robotaxi progress in Austin and bullish sell-side forecasts pushing the stock narrative higher versus real regulatory teeth in California that could force marketing changes or, in the worst case, a temporary sales suspension. For tomorrow, watch two things. First, whether Tesla responds publicly with specific compliance steps for California DMV requirements, and second, whether we get more detail on the Austin Robotaxi program, service boundaries, safety metrics, and any hint of commercial expansion. If you want this breakdown every day, subscribe to Tesla Daily News Podcast and follow us for your daily, investor-focused Tesla update.